So I'm going to start just some basic fundamentals. My name is Dr. Adeliba Mishai. I'm a CPA. I live in Calgary. I've been an accountant for 20 years. The last 5 have been the most exciting because I've been working for myself in the last 5 years. Prior to that, I worked with PwC in Lagos. I worked with a junior oil and gas company here in Calgary for 3.5 years. Then I joined EY for 2 years, and since then, I have been working as principal at Dexteritas Professional Corporation, an accounting firm that I started here in Calgary. So how we're going to do this today is real quick. We're going to go through the high-level changes that have happened as far as the tax laws in Canada are concerned. Then I will speed through the basic fundamentals, what we need to know to be able to make decisions that would impact us. So most likely I'll be done in the next 10, 15 minutes max. That's the time I'm giving myself. And then Simi is going to come talk about the long-term tax savings opportunities that exist, right? So that's how this is going to go. But I'm focusing on how can you optimize for tax on your base income right now. So Canada is a beautiful country where you live in one province, but you are part of a country, and then you find out that each province and territory is unto itself an institution, and so is the federal government. So every single one of us is dealing with at least two levels of taxation: federal taxation and provincial taxation. So when you look at your tax brackets, you see that there's first the federal bracket, and then there is a provincial bracket. So there are two sets of people slicing and dicing your income and determining how much you are going to get at the end of the day. And it's very important for you to understand that, because that's how you get to determine what is available for you to keep at all in the first place, right? And of course, outside of income taxes, you have sales taxes. So every time you go to the store, you buy something, whether it's Best Buy, Home Depot, sometimes even a restaurant, you are paying one of these and more, right? There's GST, which is federal, it's 5%. There's PST, which when harmonized with GST becomes what is known as HST. PST typically, if I remember well, is at about 8%. So PST and GST together come to about 13%. And then there are provinces like Quebec that have their QST, which is approximately 15% across the board. Goods and services that are taxable are determined at the federal level. And that's clearly documented on the CRA's website. And it's a great place for you to get an understanding of whether the goods and services you are buying as a professional or selling as a professional are taxable. Those are things that are important for you to know when you work for yourself, because sometimes they have cash implications, i.e. cash going out the door or cash coming in the door. Now, when it comes to personal taxes, there are all sorts of opportunities for deductions, same with business taxes, but it makes sense for us to understand them. When we are looking at the business side of things, the fundamental side of things, we'll walk through some of this in a little bit more detail. As far as changes in 2025 are concerned, these are the bright lights. RRSP contributions have been indexed to $32,490. That's where your 18% maximum is capped at. The home buyer's amount, i.e. what you can borrow from your RRSP to buy a house, has gone up from $35,000 to $60,000. That is significant, because now in this day and age with home prices where they are, your $60,000 suddenly is able to finance the 5% that you may require to buy your home. So that's a big deal. That's a real big deal. Now, for anybody who has used the home buyer's plan from their RRSP to fund or is planning to use that to fund a home purchase, you now have a grace period of 5 years instead of 2 years. The most important part is that you do not forget to start paying back when you hit the 5-year mark. Do not forget to start paying back once you hit the 5-year mark. Of course, we see that Canada CPP has gone through significant changes, with CPP becoming CPP1 and then a new tranche of CPP kicking in this year, which allows a maximum deduction of $4,034. The thing that you have to note about this is if you are self-employed, you're going to pay this twice. You pay it as an employee working for your own company, and then you pay it again as the business, right? That is the employer. So you pay it as employer and employee, even though you are one and the same person. That's just comes with the territory. The basic personal allowance as at last year was indexed to $15,000. That's gone up to $16,129. This is a great thing to know for anybody that has minor kids and has a business. There may be opportunity for some tax savings with that. TFSA limits are $7,000. FHSA limits are still $8,000. I think they've been $8,000 since inception. So that's information to be aware of. And our tax bands have gone up. It used to be, I think, 52. Now it's 57,000. First $57,000 is taxed at 15%, and the brackets go on that way. These are the federal tax brackets. Your provincial tax brackets are different. So, for example, if you're in Alberta, that first rung is taxed at 10% in Alberta. So somebody earning $57,000 in Alberta is going to pay at a 25% rate on their taxable income. Yeah. Capital gains. I think as of this morning, I was still reading that they had moved that till next year. So even though your primary residence is exempt, thanks to the principal residence exemption, the inclusion rate for taxable capital gains was raised to 67% last year to kick in this year, but I'm aware that a decision has been made to push that till next year. Probably that's because they want to wait till after the elections and then the new government will decide whether it gets to kick in or not. Fingers crossed, let's hope that stays at the status quo. And then the rate at which that exemption kicks in is at least $250,000 of capital gains. That's when it starts to become a thing for you to worry about in the first place. So these are bright lights, key changes, things that we need to be aware of. And then tax planning accounts that we need to know. Principal among them, your RSP. Why is the RSP important? Don't forget, every year you have the opportunity to make a contribution to your retirement. That contribution is considered to be income you have not earned. So if you put $1,000 in your RSP, that $1,000 is taken off your taxable income before your tax is determined. Now imagine a situation where you max that out on a 100K income at $18,000. Your 100K income suddenly becomes $82,000. And then looking at these tax brackets, you see how that could make a change for you, right? You have a lot less income in that 20.5% range, which is beneficial to you because taxes have been taken at the 100K level, but you are going to pay it at the $82,000 level, which means that your refund is a much chunkier, nicer amount. So everybody who gets a check in March or April, this is something that you always consider to plan for. Your FHSA operates very similar to the RRSP in that sense. The only difference is that, well, it's towards your first home, lifetime contributions of $40,000, no more than $80,000 for each year. It's advised that you open your FHSA immediately, even if you're not going to use it, because you are creating room by opening it. So that's just something to be aware of. Now, tax advantaged accounts, a TFSA, definitely. I like to pause when I'm talking about the TFSA because even I did not understand how powerful a TFSA can be. But imagine a situation where you are contributing a consistent $300 on a monthly basis for 20 years, and it's growing at the same rate as the S&P 500 or some other exchange, some other index basis. I'm going to wait for Simi to come and tell us the kind of numbers that we'll be discussing arising out of your $300 monthly contribution when it goes into a TFSA versus when it goes into a non-registered investment account. RESPs provide long-term savings for children's education. It's a beneficial thing to do. It's a great thing to do. And it also supports you being able to use that income when the kids are going to college. It's primarily for post-secondary education. So that's something to be aware of. So those are our tax planning accounts, right? RSP, FHSA, TFSA, RESP. Things to consider when you're withdrawing from your RSP account, do it in tranches of $5,000. When you take $10,000 at once, you pay 20% in taxes. Whereas if you take $5,000 twice, you pay 10%. So it's just something to be aware of there. Your RRSP contributions and FHSA contributions, those help you as far as your income tax is concerned. So I just like people that I work with to be cognizant of that. So right now, I'm just going to make a quick switch just to share some basic fundamentals with us. Okay. First things first. This is for education. If you want us to talk about this, you can reach me at talktome.dexteritas.ca. You can book a consult there, or discoverycall.dexteritas.ca. Those are places that you can reach me out, and then I can deep dive into your personal situation as far as taxes are concerned. But from a tax perspective, these are the fundamentals. Taxation in Canada is enshrined in the law. There's some people that keep spreading this old wives' tale that, taxation is a war act thing and, it's illegal to pay tax in Canada and all of that. Old wives' tale, don't fall for it. Don't make anybody tell you otherwise. The CRA is in charge of that. And I want us to be aware that everything that you need to know and to be compliant as far as taxes are concerned is publicly available to you on the website of the CRA. The challenge is always finding the right thing, and that is my job. Now, I want you to also be aware that the employees of the CRA work for you. Take note, the employees of the CRA, they work for you. So if they are lacking clarity, or you get a letter, you don't understand it, and you're not ready to pay somebody like me to interpret it for you yet, you can actually pick up the phone and call the CRA and say, hey, I got this, I want to understand. Can you break it down for me quick? Sometimes it may be beneficial to talk to the second level, not the first level, because the first person that you are talking to most likely may not know any better than you. But if you are speaking to his line, you will be able to get somebody who understands clearly what is going on and is able to give you information that is beneficial to you. Now, just take a look at that diagram that I'm sharing. That's the meat of the matter in terms of how you earn income and how the taxes are determined. Everybody in Canada has 4 fundamental basic streams of income. Employment income, which means you work for somebody and you get a T4 slip, or you're on some kind of government benefit. Business income, which means you're a sole proprietor of some sort. You earn income, you write off expenses, and all that goes into your taxable income bucket. You own a property, whether it's a house, a car, a song, a book, and somebody pays you for using that thing, right? Whatever that thing is, that's property income or rental income. And then that property, from time to time, you would sell it. When you sell it, you have either a capital gain or a capital loss. Those are the 4 buckets under which your income in Canada is recognized. Yeah, those are the 4 buckets. Now, all of that flows into what is known as taxable income, or the technical term net income for tax purposes, after certain adjustments are made. And those adjustments are the things that we typically chase around. Did I contribute to my RSPs? Do I have medical expenses? How about the kids in daycare? How much did I pay for childcare? How much did I pay in tuition fees? How about my dental expenses? Vision care? What about association and membership dues? All of that, those are all just adjustments. Now, what I want you to know about adjustments is that all of them are gated at 15%. Let that sink in. So every time the government says, oh, we have this credit or this deduction that we are allowed to take, and it's $100, that $100 is actually never really $100. It's 15% of $100. There are only 2 credits or deductions that are gated at higher rates, and that's charitable donations and charitable donations, and one more. The second one skips me, but charitable donations is definitely something I want to always draw attention to. Now, everything else is gated at 15%. So because of that, when you hear the number, oh, we'll give you it's a $10,000 first-time home buyer's credit, the impact on your taxes is not $10,000. It's a $1,500 reduction because that $10,000 is gated at 15%. So that's just an FYI. And the reason why I put this image out here is for you to say, hey, should I be chasing the deductions around the adjustments that are gated at 15%, or should I be considering and looking critically at how I earn? Does that make sense? That's food for thought for you. Okay, so a lot of the other things here are very specific to business owners and entrepreneurs. But what I want to draw attention to is the fact that you have these 4 earning streams available to you. And those 4 earning streams are where the calculation of your taxes start from. It is beneficial if you sit down and say, how am I earning and how effective is this earning stream as far as my tax management is concerned? Simi, are you ready?
Yeah, sure. I'll tell you.
Fantastic. So that's pretty much all I have for taxes. If there's a Q&A opportunity when we're done with this, we can take questions at that time. Simi, over to you.
Okay. I just want to confirm if people can see my screen.
Yes, we can see your screen.
Okay, good. So thank you for this opportunity to present. What I'm going to do is what Dotu just did was give us like a crash course on taxes and taxation, right? And it is very possible, if you are not in the financial industry, to be very lost and not understand half of what he's saying, right? I will use an analogy to explain what's going on in the financial industry. In 2025, for the average person, so I would say the middle class person, to keep in touch or to stay ahead of the curve in terms of his finances, he needs an army of financial professionals, right? So if I use the medical field as an analogy, right? You have different types of doctors. You have general practitioners, you have pediatricians, you have heart doctors, you have all sorts of people. In 2025, you need people with different areas of specialty, right? To be able to achieve whatever it is your objectives are. My name is Simi Ajayi. I specialize in retirement consulting. You can think of me using the analogy of the medical industry. You can think of me as sort of like a general practitioner, right? Dotun, who is a CPA, is I think
they said they are testy.
Okay, thank you for muting that. So Dotun is a specialist he's a CPA, but he specializes also in taxes, right? Part of what I do, I'm a licensed financial professional. I'm licensed here in Alberta. I'm licensed in Manitoba, Ontario, British Columbia. I'm extending to the US in 2025. But more importantly, I help to manage a group of over 100 licensed professionals, each one specializing in different things, right? You'll see in the course of my presentation why this is important. Like I mentioned earlier, if in 2025, if you want to keep, even as a middle class person, if you want to keep in touch with your finances, you need a small army of licensed financial professionals to help you. And this is because most of us, I've heard people ask me, why do I need to plan my finances? What's most important? Why is that important, right? In the context of retirement planning, the truth is that most of us, and this is part of what Dotun also mentioned, I'm assuming most of us here, of course, most of us here are Salesforce professionals, right? And we earn active income. So there are two ways in which you can earn income, right? You can earn income actively and you can earn income passively, right? A lot of us, most of my clients are between the age of, let's say, 25 and let's say 55, right? In that age range, you are most likely earning income actively. So I'm a Salesforce marketing cloud consultant, right? How do I earn money? I go to work, even if I'm working from home. The idea is that I exchange my skills, my efforts, my knowledge, the value I bring using my skills, knowledge, and whatever, I exchange it for money at the end of the month, right? But the truth is that if I do not actively go to work, I'm not going to earn money. And the truth is that at some point in my life, for whatever reason, either I want to retire or I'm just not skilled enough anymore, or whatever it is, at some point in my life, I will not be in the position to be able to actively exchange my skills or my knowledge or whatever it is I'm exchanging for money, right? And this is why it is important to be able to earn passive income. So a very good example of passive income or people who earn money passively is if you own rental property. I'm sure quite a number of us here own rental property, right? At the end of the month, if I'm a landlord, my tenant pays me $3,000 every single month, right? That money he's paying me is passive income because whether I get up to work in the morning, I don't get up to work, that money enters my pocket. Like